Hello, understanding risk is today's subject. If you're considering purchasing a business, starting one, or selling one for that matter, this video blog will help you assess and understand a critical risk factor to consider. If one is selling one's business, it is helpful to understand the risks as viewed from a purchaser's perspective. If one is considering purchasing a business, being aware of potential risk factors will better prepare one in the assessment of and consideration of such an investment. This should not be considered exhaustive. It is meant to be provocative in nature and make you aware in order to better be prepared in the purchase or sale of a business. Though there are many risk factors to consider, other than the obvious ones such as pending litigation and numerous others, in my view, one of the first and most important risks to consider is that of one's investment. I know this appears general in nature, but it's not, and let me explain. If one invests, say, $500,000 in the purchase of a business, it is generally presumed that such an investment will generate a specific level of earnings or income, bottom line profit, that will provide for some basic cash flow coverage such as a living wage in the case of an owner-operator, or a management's wage in the case of a synergistic or strategic or industry purchaser, as well as, of course, a reasonable return on one's investment. And this would consider risk, the ability to debt service when the investment is being levered. That return on one's investment considering risk is really what we're talking about here today. So what should that return on investment be? Well, that is why understanding risk is so important. Generally speaking, the higher the risk, the higher the anticipated rate of return. The lower the risk, the lower the anticipated rate of return. So the next obvious question is also the million-dollar question. What is a reasonable expected rate of return bearing normal risk? That then provokes yet another question. What is normal risk? Well, normal level of risk really is often based on one's level of risk tolerance. But in general terms, we consider a normal return on invested capital in what we call Main Street transactions, meaning non-financials, non-strategic or synergistic acquisitions, to be in the range of 35%, and this typically includes the owner's salary. So in other words, a total benefit to owner. In financial or strategic or synergistic transactions, that return on invested capital could be as low as 15% and would typically average around 20 to 25%. So generally speaking, however, that return on invested capital is then increased or decreased based on a myriad of upward or downward value drivers and risk probability considerations. By example, a business that has been around and profitable for, say, 30 years will likely be less risky than one that has only been around a couple of years and just recently been profitable. Please bear in mind that each situation needs to be assessed on a one-by-one basis, as there is no one-size-fits-all when it comes to assessing risk. A professional assessment of value of any business would consider and reflect a realistic return on invested capital based on considered risk probability. Also, generally speaking, a larger business typically is less risky than a smaller one, and often directly related to the personal goodwill versus commercial goodwill, which, if you remember, we covered that in one of our previous episodes. Though there are many other risk factors to consider when purchasing a business, such as client and customer concentration, corporate culture, employee issues, inventories, competitors, intellectual property, competition, sustainability and economic predictability, liability considerations, and of course many more, it is equally critical to realize that no matter what, there will always be a risk in starting, running, or purchasing any business. Risk is a part of any business, and the two really go hand in hand. What is important is to understand one's own level of risk tolerance. Understand the potential risk and the level of probability of such risk materializing is absolutely critical. Failing to do so could place your hard-earned dollars at risk and/or with excessive legal fees in protecting you mentally while remaining exposed physically. A professional, credible, and knowledgeable business broker can certainly assist you in understanding the risk in order to make safer investments into a business through better and more informed decisions.